Welcome to The Explainer. Let's just jump straight into this epic tug of war happening today, July 17th, 2026. Right now, we're seeing panicking retail traders colliding head-on with some truly massive institutional moves in the crypto market. Today, we're breaking down this complex defensive cycle to give you the clearest possible picture of exactly what is driving all this chaos.
So take a look at this number right here, 26. This isn't just a random metric we pulled out of thin air. This is the 15-minute Fear and Greed Index score for Bitcoin today, and it shows a market that is violently plunged intraday into extreme fear. To really understand why the crowd is so panicked today, we have to dig into the underlying structural forces that are pushing them to the edge. Section 1. The Market Battlefield. Technicals and Liquidations. Right now, Bitcoin is sitting at around $63,370. It's down roughly 1 to 2% on the day, and it's really struggling to hold on to that crucial $63,000 support level as global liquidity continues to tighten. And look, this is a highly vulnerable threshold. Analysts are actively warning that if Bitcoin fails to hold $62,500, it could trigger a much faster, sharper drop towards $60,000, which would essentially mark the end of our recent bounce.
And this perfectly illustrates exactly why analysts are being so incredibly cautious right now. We just had a failed rally up at $65,500. The technical fallout from that? Bitcoin has now broken down below the bearish Ichimoku cloud, specifically that 62,885 to 63,599 range. For those tracking the technicals, you know this is a classic bearish signal. That failed rally, combined with breaking below the cloud, has shifted the technical backdrop decisively in favor of sellers.
Now here's the brutal consequence of that price action. Nearly $400 million in leveraged positions were completely wiped off the map in just 24 hours. And out of that, an overwhelming $335 million represents liquidated long positions. Over-leveraged long traders, the folks betting heavily on the price to just keep going up, are taking the absolute brunt of this hit as the market violently flushes out all that speculative excess.
Section 2. The Bear's Arsenal. Macro Pressures and Security Risks. Okay, so on top of the technical breakdowns, we have an absolute barrage of macro pressures acting like gravity on Bitcoin's price. We're talking rising U.S. Treasury yields and a strengthening dollar, which naturally increases the opportunity cost of holding non-yielding assets. But crucially, we also have escalating geopolitical tensions, including U.S. strikes on Iran and fresh threats to the Strait of Hormuz. All of this is tightening global liquidity and forcing the market into a very defensive, risk-off posture. And adding fuel to that bearish fire, we have a fresh security hazard hitting the tape. The cross-chain bridge across reported a hacking attack on the Solana network earlier today. Now, to be clear, the protocol stated that all user funds are perfectly safe and cross-chain transactions initiated before the breach completed normally, but deposits to Solana have been temporarily suspended as a precaution. In the short term, incidents exactly like this erode trust in DeFi and bridges, which usually leads investors to ditch altcoins and run back to major assets for safety.
Section 3. The Political Wildcard. Regulation in Washington.
Let's pivot to the political side. Today brings a pivotal House Financial Services Committee field hearing in New York regarding the Digital Asset Market Clarity Act. Now, while this specific hearing can't pass the law itself, it's widely viewed as the single biggest lever Washington can pull to give us some regulatory certainty in 2026. The catch? Disputes over ethics provisions regarding government officials' crypto holdings mean the bill reportedly lacks sufficient Democratic support. Thanks to this political gridlock, prediction market odds for the bill passing in 2026 have collapsed to just 43%. Because of this intense legislative gridlock, any proposed regulatory agendas, like the ones mapping out future crypto asset rules or broker-dealer rules, are essentially just frozen in time. The big fear driving the market today is that failing to pass a bill before the August recess pushes any hope for a federal regulatory framework completely out into 2027. When you read quotes like this from SEC Chairman Paul S. Atkins talking about envisioning a system that embraces innovation and creates clear rules of the road, that is exactly what the industry was hoping to lock in this year. Instead, the failure to secure these safe harbors is keeping a ton of institutional capital just sitting on the sidelines, waiting, which contributes heavily to today's bearish momentum.
Section 4. Institutional heavy hitters, the bulls fight back.
But actually, hold on, because here is where the story shifts dramatically. Despite all that retail panic we just talked about, spot Bitcoin ETFs continue to see incredible structural support. Spot Bitcoin ETFs pulled in $108 million in a single day, with BlackRock's IBIT ETF driving a staggering 75% of that flow.
Institutions aren't panicking. They are deploying massive capital as a powerful counterweight.
And when we compare the assets to see exactly where the heavy capital is landing, Ethereum ETFs pulled in a very respectable $53 million. But it is crystal clear that Bitcoin remains the primary anchor for traditional institutions. They're consolidating around Bitcoin's macro store value narrative, totally looking past the short-term noise and volatility of the altcoin market.
Then we get an absolute blockbuster move. $400 million. Citadel Securities just injected this exact amount into Crypto.com. This is a massive milestone. It's the platform's first ever institutional funding round, and it boosts the company's valuation to an eye-watering $20 billion.
So, why does this matter? Well, as Citadel's Jim Esposito highlights right here, this is about the permanent convergence of traditional financial markets and digital asset infrastructure. This isn't just a simple tech investment. It is a permanent bridge being built between legacy capital markets and digital platforms to improve overall market efficiency.
And building directly on that exact theme of convergence, HSBC was just approved to operate in the UK's digital sandbox for the Digit pilot. So despite the bearish short-term technicals, the literal plumbing of the future financial system is aggressively being laid down right now by traditional powerhouses.
Section 5. Gauging the crowd's fear. The tug-of-war result.
So let's tie this all together. We have a market that is completely torn in half. Looking at the wider, longer-term daily sentiment, the crowd sits at a totally calm, neutral 46. But that intraday panic, driven by the technical breakdowns and leverage washouts we explored earlier, is violently pushing the fast-moving 15-minute score down into extreme fear at 26. The short-term noise is practically deafening, and it's masking the long-term structural builds happening in the background.
Which leaves us with this final provocative thought for you to take away today. With giants like Citadel and BlackRock quietly building the literal plumbing of tomorrow's digital economy while retail traders panic over today's technical drops, are we actually witnessing a true market breakdown, or is this simply the chaotic noise of institutions taking permanent control of the asset class? Think about that as you watch that $62,500 support level this week. Thank you so much for joining me on this explainer, and as always, keep your eyes on the data.